We are now connected with Viani Puspitasari, an expert on international economy from the Padjajaran University. Hello, Viani. Thank you for joining us once again on the 3 Hour News Show. You are a regular, I believe, here. So this 9.1% inflation is the highest in the U.S. has experienced in the last 41 years. Wow, it is much higher than initial estimates made by various economists, media outlets, and institutions. So what do you think that is causing this situation?
Well, inflation in the U.S. hit a fresh 40-year record in June 2022, with the consumer prices increasing 9.1% over the last 12 months. And it's the fastest increase in prices since November 1981, and of course, above what economists had expected. It was up from 8.6% rate in May, exceeding the 8.8% gain. On a month-over-month basis, consumer price index rose 1.3% compared with May, topping expectation for 1.1% gain. When it comes to the cause of the soaring inflation, we might falling into three related aspects. The first one is strong demand. Consumers are spending big early in the pandemic. Households amassed saving as they were stuck at home, and government support that continued into 2021 helped them put away even more money. Now people are taking jobs and winning wage increases, and all of those factors have padded household bank accounts, enabling families to spend on everything from backyard grills and beach vacations to cars and kitchen tables. And the second causes is there are too few goods. It means that as families have taken pandemic savings and tried to buy pickup trucks and computer screens during the pandemic, they have run into a problem. There have been too few goods to go around. Factory shutdowns tied to the pandemic, global shipping backlogs, and reduced production have snowballed into a parts and product shortage. Because demand has got beyond the supply of goods, companies have been able to charge more without losing customers. And now China's latest lockdowns are exacerbating supply chain growl. At the same time, the war in Ukraine is cutting into the world's supply of food and fuel, pushing overall inflation higher and feeding into the cost of other products. And gas prices are averaging around $5 now a gallon nationally in the United States, and up from just over $3 a year ago. And the third one is the service sector pressures. More recently, people have been shifting their spending away from things and back toward experiences as they adjust to life with the coronavirus. And inflation has been in service industries. Rents are climbing swiftly as Americans compete for a limited supply of apartments. Restaurant bills are heading higher as food and labor costs rise, and airline tickets and hotel rooms cost more because people are eager to travel because fuel and labor are more expensive.
Yeah. All right, so Fiani, this is Caroline right here speaking. It is inevitable because we know that inflation is happening across the world, but myself, I just went back there a couple of days ago, and me and my family were actually trying to get a house since 2 years ago, and we already felt the inflation since then, especially on properties. So, but now it's coming to your daily needs, to your goods. Now, Americans are also paying more for various products since inflation continues to stagnate the U.S. economy. So what do you think foreseeable to seeing this situation, and when do you think, what would you predict this is going to subside, especially from the United States?
Well, this is the things that actually occur in times of inflation, where people spend more money to buy their necessities. In times of economic uncertainty and inflation, most households tend to hold back on buying luxury goods. But by and large, people can cut down on necessities such as groceries, transportation, housing, etc. And the shift of spending away from items like vacations and new cars and toward necessities pushes inflation up for poorer families than richer ones. And this is because lower income households dedicate a higher percentage of their income on necessity. And I think that the lower income people or inhabitants will suffer from this inflation for such quite a long time in the future. And this is the things that the government need to help and tackling down the problem.
And just adding on to what you said, Fiani, and also Alia, we see a lot of, it is a state of emergency, especially in California, because there's a lot of homeless people now. They're out of jobs, they cannot pay their rent, they cannot pay their mortgage, so they're out in the streets, and the city itself cannot do anything.
Unfortunate.
It is.
But okay, let's switch our focus back in the region of Southeast Asia and also Indonesia in particular. We're doing quite good, I believe, because we're now enjoying the commodity boom and also the confidence of the people. The economy is big, but the buying power is still rising. Do you think this inflation in U.S. could affect economies in Indonesia and also parts of Asian countries, Southeast Asian in particular?
Well, as inflation in the U.S. is expected to continue to be high, and this has prompted the U.S. Central Bank to aggressively raise interest rates. As the case for Indonesia, the trade balance line further. Then another effect is that the cost of raw materials coming from the U.S. or shipped from the U.S. will increase in price. And this price increase will later be passed on to consumers so that there is a transmission of higher inflation in the United States to the prices of basic necessities in Indonesia. And meanwhile, consumer prices are rising sharply in Southeast Asia's largest economy, which is suffering the effect of surging oil prices and disruption in global supply chains caused by Russia's invasion of Ukraine. The war is also wreaking havoc with palm oil prices, and despite being the world's largest producer of palm oil, Indonesia is suffering from cooking oil shortages that are adding to overall food inflation, then followed by soaring inflation of the United States. Rising global inflation could weaken ASEAN economic recovery in 2022. In June, the World Bank projected in its global economic prospects that the inflation rate in advanced economies rose from 1.9% to 6.95% in the year to April, while the inflation rate in the emerging and developing economies increased from 4.23% to 9.37% over the same period. And the surge in inflation has put pressure on central bank to tighten monetary policy to control rising prices. And tightening financial conditions, especially in major advanced economies, could reduce their foreign direct investment outflows to ASEAN economies. And the U.S. Federal Reserve, for example, the federal funds rate, the interest rate that commercial banks pay to borrow reserve balances overnight from Fed, 3 times in the first half of this year, from 0.25% in March 2020 to 0.50% in March this year, then to 1% in May, and 1.75% in June. A higher interest rate increased the cost of borrowing for both business and consumers. The credit reduces domestic private investment and consumption while discouraging firms to invest overseas. And foreign investors are less able to expansion of ongoing projects or investment in new ones as the cost of production, usually financed by bank borrowing, rise.
Wow.
And, in fact, FDI inflows provide the largest source of external finance in economies. The U.S. is listed as the largest source of FDI inflows into ASEAN within $35 billion, or 26% of ASEAN's total foreign direct investment inflows in 2020. And the reduction of FDI inflows could weaken ASEAN economic recovery by reduced opportunities for the ASEAN workforce capital, opportunities for the ASEAN workforce capital to finance private investment, and corporate tax revenues to finance public expenditures. And the upward trend of inflation is also observed in the ASEAN economies as a group. The average inflation rate in ASEAN countries increased from 0.9% in January 2021 to 3.1% in December 2021, and then to 4.7% in April 2022. And for ASEAN economies have experienced a increase in the inflation rate in the year to April. This includes Indonesia, Singapore, Laos, and Thailand, And the inflation rate declined in Malaysia while it remained mostly unchanged in the Philippines and Vietnam.
Right.
Indonesia's inflation rate in June took its biggest leap in nearly 5 years as more consumer-facing business pass on rising costs via price increases. Indonesia's consumer price index now, well, everything changes a lot. Yeah.
There's always that tipping point, right? Especially when things are shifting. Now, amidst the pandemic, 2.5 years, everything was just stagnant, but now everything is ongoing, and especially with the ongoing war, also and the conflicts and whatnot, I think everything is just so adapted, and it has to shift every time, and we have to follow up with that too.
True.
Now, Viani, Caroline here again. We want to shine our light now to something that really caught our guard last week, where the euro is currently valued below the dollar for the first time ever after 20 years. Now, should this be an alert for foreign exchange investors?
Well, we can say that well, it's rather hard to answer right away.
Is it something that we need to see for like a couple of period of time until you can until we can also predict if this is going to be a change of currency?
Yeah, because it's rather hard for every investors to do something right now.
Right.
The safest way for them is just wait. The conditions might grow or develop. As a matter of fact, the Fed now has made a policy to tackle down the problem, and also at the same time there is another policy that made by another government to save to create a safe haven for its condition right now.
All right, it seems like things have changed and are still changing. Things are still changing quite rapidly, and we need to still see what's going to happen. And unfortunately, the uncertainty that was caused by the pandemic is still going on right now. So, Viani, thank you so much for speaking with us and giving your insights here in the 3-Hour News Show. We really appreciate it, and stay healthy.
Okay, thank you.